The year 2020 has certainly seen its fair share of events, from the onset of COVID-19 to the recent US elections. Despite this backdrop of uncertainty, global equities have rebounded to pre-COVID-19 levels, bolstered by massive government stimulus and, more recently, very positive news on the COVID-19 vaccines. As we head into the new year, world markets continue on their path to recovery. And what should investors look out for in terms of risks? We speak with Citi strategists on their outlook for 2021. Is the global economy headed towards a normalized growth path in 2021? And Ken, is there anything that could potentially derail this recovery?
Well, yes, Sumaira, after a year like 2020, we could certainly use a little bit of good news. Unfortunately, we do have some of that good news coming. We've always had the view that in order for the world to return to some kind of normalcy, we'll need a trifecta of developments. The first one, we need to know who the next president is for the United States. Secondly, we need to have an efficacious vaccine as well as treatments for COVID-19. And thirdly, until we get those medical solutions, we need to make sure that there's enough money to go around, fiscal, monetary, to help with difficult economic conditions. Within those three, by far the most important is medical advance. And I think those things, medical advance is likely to be available by the first half of next year. In 2020, global growth is slated to shrink, and by 2021, we expect that to bounce back. That is going to be certainly above trend, so by 2022, we could see a bit more settling down of that growth. But for 2021, I think a year of strong growth is very likely. You asked me about risks, and I think there are some, the most principal of which is, before we get the medical solutions, how long is this waves of COVID-19 infections going to last? Given that we're going from the first year of economic recovery into the second year, in 2021, there will be enough growth in economic activity to make those risks manageable.
Amid very supportive policy stimulus throughout this year, as well as growing signs of economic recovery, global equities have rebounded to pre-COVID-19 levels. Ken, do you see a lot of opportunities left in the market?
Well, yes, you mentioned policy support, right? So we had just talked about the global economic recovery, so that's definitely supportive of equities. On the surface, it looks like we had a great year. But look below the headlines, you'll find that stay-at-home stocks, things that you do, companies that make money from people staying at home, like internet, like media, these guys have rallied 50 to 70% this year. But when you look at the leave your home types of stocks, basically companies that require to leave your home in order to make money, like airlines, cruise, hotels, like retail, real estate, and those stocks have done poorly, and they remain 30 to 50% below where they were at the start of the year. So our view is that that gap is going to narrow in a dramatic way as global economies reopen. Aside from industries, we think the markets that have the highest beta and the most cyclical content, such as Europe, the UK, Southeast Asia, LATAM, I think these markets might do better when we do have more reopening. Now, looking out longer term, we still believe that what we call unstoppable trends will continue. The first of which is digitization, right? At the moment, we're focusing on hyperconnectivity, basically 5G, faster connection, lower latency. We think that 5G supply chain will continue to drive a lot of demand. Think about this, right? At the moment, we have about 250 million 5G subscriptions around the world. By 2025, that's going to become 3.6 billion. That's 14 times increase over a 5-year period. We also think Asian development is a very important theme because this is where global consumption growth will come from in the next decade. The number of middle class will rise by 1.5 billion in the next 10 years. And finally, we think greening the world is going to be a very important theme. One, the cost of alternative new renewable energy is coming down so much that it's becoming competitive with traditional sources of energy without subsidies. And secondly, global governments are putting in more resources to develop new energy, to develop green energy. That includes Europe, the UK, China, who wants to be carbon neutral by 2060. And it also includes the United States, which under President Biden is likely to put out more regulations and more policies to promote sustainable development.
Central banks around the world have pulled out all the stops, boosting financial markets with massive asset purchases, as well as pushing government borrowing costs to historic lows. Lena, do you see this accommodative policy continuing into the future?
In the US, the Federal Reserve is expected to keep policy rates at zero lower bound for until 2023 to 2024. The Federal Reserve's new policy guidance, forward average inflation targeting, should see rates stay unchanged, even if inflation overshoots its targets. Central banks will remain supportive, and Citi forecasts $6 trillion of global asset purchases in the 12 months following initial quantitative easing announcements. This will be 3 times its previous peak.
In this low interest rate environment, cash is no longer king. Lena, for clients that are looking for yield, what area should they consider?
Holding excess cash in today's ultra-low rate environment is indeed a costly strategy. We therefore encourage investors to continue to look for opportunities to pick up yield while staying diversified in portfolio risks. Firstly, as mega-cap technology names have driven up US equity indices, US high yields have been weighed down by larger exposures to COVID cyclical sectors such as industrials, energy, financials, and real estate. This is also where we see the most favorable risk versus reward, with the Fed willing to backstop any further deterioration in financial conditions. We also favor fallen angels, basically investment-grade names that have been recently downgraded to high yield. Over the past 23 years, fallen angels' annual returns have exceeded broader high yield by 17 times. As for emerging market debt, US dollar emerging market aggregate index spreads are still wide. Considering a quarter of the global fixed income markets are trading at below zero yields, and BB- high yields are paying 4.1%, US dollar emerging market debt at yields of 4.4% remain relatively attractive.
Jay, what do you think the top 3 drivers are going to be for FX in 2021?
1. The dollar structural weakness to extend. 2. A stronger Chinese renminbi. And 3. The hunt for yield by investors as the risk backdrop improves in 2021. And we think the risk backdrop is going to improve for 2 reasons. The first is vaccine optimism is likely to dominate the successive waves of COVID infections that we have seen in 2020. And secondly, we've got a Fed which is now ready to commit to underwriting any fiscal shortfall or disappointment that may arise because of a clash between a Biden presidency and a Republican Senate. More positive risk backdrop means less safe haven demand for currencies like the US dollar. When we come to the Chinese renminbi, Chinese corporates have already started to offload their US dollars because of China's sustained economic recovery, plus the inflows coming into its current account and the capital inflows because of index inclusions. And as the PBOC now comes to the end of its easing cycle and turns more hawkish, tighter liquidity conditions are likely to encourage further strength in the currency. And finally, the hunt for yield, a combination of an improving risk backdrop, but with central banks still holding yields unchanged, then clearly investors are going to be encouraged to actively search for yield in 2021.
Citi House view is structurally bearish on the US dollar. Jay, do you see any factors that could potentially change that view? And are there any other opportunities in the interim within the FX market?
There are 2 factors that could turn around the structurally dollar bearish view. The first of these is if the Fed itself reverses its stance on soft inflation averaging. And that means it starts to raise rates early in 2021 to preempt rising inflation rates in the second half of 2021. The second is if we start to see European disintegration risks back in play because of an unacceptable financial burden on individual member states to fight coronavirus. So neither of these factors looks to be in play in 2021. In terms of the opportunities against a structurally weaker dollar, as real yields fall, that's going to benefit the major G4, things like the euro and the sterling, who look well placed to benefit from falling real yields in the US dollar, and gold. Gold typically does well when US real yields fall and the dollar weakens. When it comes to a strengthening Chinese renminbi, once again, the euro is a very clean proxy for the Chinese renminbi because of the many massive trade between Europe and China. And then you also have in the local context the Singapore dollar and perhaps even the Taiwanese dollar and the Korean won, regional currencies that are strongly anchored to the CNY as proxies. And then the commodity currencies, the Australian dollar, the New Zealand dollar, and the Canadian dollar.
We hope you found these insights useful. Please stay safe and healthy during this period. And if you have any questions or require more information, please don't hesitate to contact your Citigold Relationship Manager.